Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. Where do I even start? Yesterday was absolutely a crazy day. It was a red day like we've never seen. I mean, to be honest, I kind of expected this to happen, okay, because the way things are going right now, the US Fed came out, Chairman, whatever his name is, came out and said, you know what, we're going to keep increasing interest rates until inflation comes down. And that's it. So inflation goes up, the interest rates will go up. So they are fighting with the inflation right now, and that's what they're going to keep doing. So there's no surprise that the market has actually reacted this way. But I'm really a little bit surprised, because I'll be honest with you, I thought people have already made up their mind about the fact that the interest rate is going to go up while inflation is still high. So I don't even know what basically he said that was not kind of expected. So we'll see. But generally, I'm still buying stocks. We're going to carry on what we've been doing. And this kind of red days sometimes give us an opportunities. I mean, we need more of this, maybe 2-3 days of like this, to be able to find a cheap stocks, because one day is not going to make a huge difference. Microsoft going down 3%, all of a sudden it's not going to be cheap. I mean, Microsoft is cheap right now, but it's not going to be, really cheap, if you know what I mean. So companies like Visas and Mastercards and whatever, even though they were down almost over 3%, it doesn't mean that all of a sudden they are undervalued, and you have to be really careful. One other thing I want to mention before I actually start the video today is Tesla. So Tesla right now is $288 per share because they've done a split. When companies do splits, right, it makes no difference to the fundamentals. It makes zero difference. All they're doing is just making more share, basically dividing that one share into, I don't know, was it three-way split or whatever it was, right? So fundamentally, the company is still the same. If the company was overvalued at the time of the split, it will still be overvalued. If it was undervalued, it'll still be undervalued. It makes absolutely no difference. I don't even know why they're doing it these days, because you can buy fractional shares. If I wanted $288 of Tesla, I can just buy it through Trading 212. So it makes no difference really. So yeah, just be careful. Don't think because they did a split and now it's 288 is already basically is all of a sudden cheaper than it was before. It's definitely not. Nothing has changed. The company is still the same. The stock's still the same. Fundamentally, nothing has changed. So just be careful of that. So what I want to do today is share with you a new company that I've actually added to the portfolio. So I've got a new stock that I bought just yesterday. So I've added to the portfolio, and I want to show you what company it is and why I've decided to buy this company now. This company is basically, I've spoken about it before, but I've managed to basically buy it yesterday at, I think, almost 3% down yesterday, right? So that company is Cisco, and you might be thinking, what the hell is going on with this guy? He said already he's not going to buy more basically technology companies. Here he is basically buying Cisco. What I did was I own Microsoft, and I own 17.2 shares. So I trimmed Microsoft because I was up at least 40%, right, almost over £1,000. So I sold 2.2 shares on Microsoft and took that money and bought Cisco. So I'm still, when it comes to technology, I mean, basically nothing has changed. Okay, it's still two technology companies, but I believe this company is really undervalued at the moment, and according to Morningstar, it is undervalued. And they are only one of the companies that came out recently that had a really nice report and gave us a good guidance when it comes to the future quarters and coming up, right? So let me show you why I actually bought this company. First of all, it has been upgraded by Morningstar from a narrow to a wide mode. And this is the reason, right? They said we upgrade our economic mode ratings for Cisco systems to a wide from narrow upon renewal confidence that the firm's leadership and economic return profile will prove durable in an evolving networking markets. So that is their reason. But they still maintain the 54 fair value estimates. Okay, so that's still the same, but they decided because of the leadership, because of basically the durable networking environment that's actually this company's in, they've decided to increase that. So change it from a narrow to a wide mode. This is one of the what I genuinely thought for a long time, this company should have been a wide mode for a long time because of their business model. Have a look at this. We view Cisco Systems as the dominant force in an enterprise networking and expect it to retain its strength in both legacy and future networks. Cisco holds the leading market shares across the switching, routing, and wireless access, with strong complementary positions in security and collaboration. We believe Cisco's portfolio is appropriately positioned to benefit from trends towards hybrid work and hybrid cloud environment. And that is another very good point that I have seen it myself. We use in our company a lot of the basic products this company creates, from security, from the server side of it, from networking devices, from even the phone that we have in our office is created by this company. Okay. It carries on and says it offers the most comprehensive suite of capabilities across converging networking and security markets, and we deem its intertwined products as sticky and worthy of a wide economic moat. So that is one of the reasons they have changed this basically company. And that's not the only thing. The only reason I'm buying this is because it has a wide moat. So once you've got that, then you just need to look at the company itself. So it's 15% discounted right now. Their price tag is 54. Last night it closed at 45.89, right? So let's have a look. Let me tell you one of the other reasons that I decided to add this company. So they have 5 different areas. Okay, so got the security side of it, the hybrid, end-to-end security as well, internet for the future, install that, like Internet of Things, okay, optimized application experience. So you got these 5 different elements, or basically segments of their business, and each one of them you can see basically how they actually, what basic products they sell and so on. So it's not just relying on one section. So you got the infrastructure platforms, okay, you got the application, and you got security. So these are the 3 major things. But let me show you the reason why I've decided. So you got some data in here, so I'm not going to bore you with this, but just to quickly to show you in terms of the fiscal year reports that they've made, $49 billion last year. A year before it was about 49 as well, but it's slightly gone up, just about 1% up. But the year before that it was 51, but that's 2019. So 2020 went down a little bit, and it looks like it's actually bounced back already. So because of COVID, so 2019 it was almost to $52 billion. That's how much they made just that year based on selling all these products. And 2020 it was 49, obviously because of COVID and what's happened to closures on offices and all of that stuff. But it looks like 2021 it came back, and now 2022 it looks like they will even do better than that. So even though they grew 1% last year, hopefully this year will be a lot better. But this is the reason why I'm actually buying this company. Okay, what I love, I don't know if you've watched my videos long enough, but one of the things I love about technology companies is annual recurring revenue. This to me is very important. This is why some companies like Salesforce have actually sticky basically product. What I mean by that is this company sells their products to companies, okay, based on like as a subscription. So it's not just I will buy one product and I'm going to go away and I might not come back. What they have is they basically have locked these customers, so they pay subscriptions every single month or every single year to have access to their products. Now, when you look at the actual products from 5.7 to 7 to 8.8, so the last 3 years you can see that it's actually heading the right direction. But this is the one I love the most, okay, 11.5 to 11.9 to right now 12.4. And that's the recurring, basically the service side of it. So both sides, Okay, both products and services are heading the right direction, and that is just the rate because of recurring annual recurring revenue. And genuinely, this is probably one of the reasons. And I actually love to see this because this company is one of the oldest networking companies out there. But the fact that they're in it basically almost the kind of restarting, if you like. They still have their legacy products, but they are also keeping an eye on what's happening in the markets. Okay, so I absolutely love this. I will show you exactly how many shares I bought, but let's have a now look at a little bit more detailed of this company. As you can see, right now it is $45 per share, EPS $2.82, and next year they're expecting $3.79. $190 billion market cap. It has a wide economic moat, as you've seen it already, and it has a very low beta in comparison to the technology sector. PE is 16, average PE for the last 5 years is 15, price to free cash flow is 14, which tells me it is cheap right now in comparison to the sector. What you then need to do is look at, again, the companies that are very similar to this company and compare it with that as well if you're really interested in the business. Annual dividend yield over 3%, which is a very nice payout ratio. We've got 44%, 5-year growth rate of 6%, dividend growth streak 11 years, dividend safety of 91, and they have $13.5 billion in the bank. This is a solid business, right? To have that sort of a cash, the growth is really good, as well as you basically getting 3% dividend for your while you wait, basically. Okay, profit margin. Okay, don't expect this to be the kind of company that will give you 20%, 30% returns. Okay, you get 3% dividend and you might get another 3 or 4%. So overall, you get about 7-8% every single year, which is really nice. Okay, that's solid predictability kind of income, if you like. Profit margin 22, almost 23. Operating margin 27, return on equity almost 29, total return in the last 10 years including dividends and the price appreciation, all of that stuff, 11.44, and current ratio is 1.5, which tells me they've got plenty of money in the bank. Right, growth estimates in the next 5 years expected 7%, which is really huge for this company. Simply Wall Street is actually saying 47% undervalued at the moment. Their price target is 86. I hope that happens. Okay, that will mean I'll double my money, I'll be honest with you. Morningstar valuations is 15%. Discount, as you've seen already, their price fair value price is 54. Tip rankings is actually saying about 19%, almost 20% upside. 55 is their price target. Same goes for Yahoo Finance, and according to Morningstar, tip rank is actually moderate buy right now. For me, it's definitely strong buy, and I bought it already. And as you can see, shares outstanding is actually been decreasing, okay, and heading the right direction. Now, to me, this is the type of business you can buy and sleep well at night. You don't have to worry about what the market is doing. You can buy more of it when it goes down, and you still get paid, and you just sleep well at night. You know the company is not in debt, and so on. Final thing I want to show you about this company is Sharia compliance side of things. And as you can see, 98.77% of their business is actually compliant. Interest-bearing debt is only 5%, and interest-bearing securities is only 9%. So there you have it. This is a great company. It's been on my watch list for a very long time. Yesterday, when I saw it going down, by then I already sold a bit of Microsoft. So I'll show you just to be transparent. As you can see, I had 17.18, I think, whatever it was. I sold basically 2.2 shares of that company, took some profit. I think it was about £200 or whatever it was. Let me just quickly show you, just to be transparent. I think 100 something, I think it was. There you go, £140 of profit. And then I took that money and bought Cisco. As you can see right now, I've got 15 shares of that. I added a little bit more, so I've got 15 shares of that company. I will let you know how it goes. As usual, I'll keep it in my portfolio, see what happens, inshallah, in the long run. But yeah, that's the company that I want to share with you guys. I hope you're enjoying this kind of transparency and this kind of analysis. And like I've always said to you, if you see me buying a company, that doesn't mean it's a buy for you as well. Your time horizon is different to mine. My situation is very different to you. Like, you might have a time horizon that's like 10 years or 5 years or whatever, 2 years. And mine is completely different. I'm looking about 20 years to 15 years from now, and I'm buying these companies. I'm going to hold them, inshallah, for a very, very long time. So you need to do your own research, find out exactly about every single thing you can find out about these companies. Like I've always said to you, I'm in the technology sector. We use their product day in, day out. So I don't really have to do much of research in terms of the kind of product, but I just needed to look at their I still had to go to their website and just look at it, how much there's some products that I didn't even know they made, this company actually created. That I found out basically last night when I was doing the research. So yeah, just look into those their financials and all of that stuff if you're really interested. I hope you're enjoying the videos. Have a wonderful day. Assalamu Alaikum.